Hello everyone and welcome to Module 4. Today we're going to be talking about fixed assets and depreciation. So plant assets are long-lived, tangible assets that are used in the operation of the business. These assets include things like land, building, equipment, furniture, fixtures, and automobiles. Often, plant assets are referred to as plant, property, and equipment, or fixed assets on the financial statements. Plant assets are different from other assets like office supplies because plant assets are long-term, meaning that they last several years. And this requires a business to allocate the cost of the asset over the years that the asset is expected to be used. This allocation of a plant asset's cost over its useful life is called depreciation, and it follows the matching principle. Depreciation is the process by which businesses spread the allocation of a plant's assets cost over its useful life. The matching principle ensures that all expenses are matched against the revenue of the period. Because plant assets are used over several years, a business will record a portion of the cost of the asset as an expense in each of those years. All plant assets except land are depreciated. We record no depreciation for land in America because it does not have a definitive or clearly estimatable life, and so it's difficult to allocate the cost of land. Plant assets are recorded at historical cost, or the amount that was paid for the asset. This follows the cost principle, which states that acquired assets and services should be recorded at their actual cost. The actual cost of a plant asset is its purchase price plus its taxes, purchase commissions, and all other amounts paid to get the asset ready for its intended use. That is key. You have to think about anything you had to pay for, any type of cash outlay you had to make, in order to get the asset ready for its intended use. Those costs are included in the cost of the asset. So the cost of land would include the purchase price, the brokerage commission, the survey and legal fees, the delinquent property taxes, the title transfer fees, the cost of clearing the land, because that's necessary to get it ready for its intended use, and the cost of removing old buildings from the land. So land is kind of a unique plant asset, and it's never depreciated. The cost of land does not include fencing, paving, sprinkler systems, lighting, signs, and other improvements to the land, such as landscaping. These costs are collectively referred to as land improvements. A land improvement is a depreciable improvement to land. So these costs are separately identified from the land itself, and they are depreciated. So what is depreciated and how is depreciation computed? So depreciation is the allocation of a plant's asset's cost to expense over its useful life. Depreciation matches the expense against the revenue generated from using the asset to measure net income. All assets except land wear out as they are used. In addition, some physical factors like age and weather can cause depreciation of assets. Some assets, like computers or software, may be obsolete before they wear out. An asset is considered obsolete when a newer asset can perform the job more efficiently than the old. Depreciation is not a process of valuation. Businesses do not record depreciation based on changes in the asset's market value. Depreciation does not mean that the business sets aside cash to replace an asset when it's used up. Depreciation has nothing to do with cash, and that is a very important concept to understand. Okay, depreciation, we subtract it on the income statement, so it does deduct from net income, but it does not deduct from cash. And that will become very important when you begin to learn about the cash flow statement. To depreciate or to compute depreciation for a period, we have to consider three primary factors: the estimated useful life, the capitalized cost of the asset, and the estimated residual value of the asset at the end of its estimated useful life. The useful life is the length of service period expected from an asset. It can be expressed in time, such as months or years, or it can be expressed in usage, such as units produced or hours used or miles driven. The residual value is the expected value of a depreciable asset at the end of its useful life. When a company decides to dispose of an asset, they either sell it or scrap it. The residual value is the amount of money that the company expects to receive when it disposes of the asset. Residual value can sometimes be zero if a company doesn't expect to receive anything when disposing of an asset. If a company plans on trading in an asset for a new asset, the residual value will be the expected trade-in value. Estimated residual value is not depreciated because the company expects to receive the amount at the end. The depreciable cost is the cost of a plant asset minus its expected residual value. There are three common depreciation methods: straight-line method, units of production depreciation, and double declining balance depreciation. Under the straight-line method, residual value is deducted from the depreciable cost and then divided by the estimated useful life of the asset. The straight-line method is a depreciable method that allocates an equal amount of depreciation for each period. So we have the straight line depreciation is equal to the cost minus the residual value divided by the useful life. And this is the most simple formula to use. So here in this example, we have a cost of $41,000, a residual value of $1,000. We're going to subtract that out, divide by 5, and we get $8,000 per year for the depreciation. And so here we can see an example of the adjusting entry that's used to record the year's depreciation expense. We're assuming here this is a truck, was placed in service on the first day of the year. And so we would say on December 31st, the end of the year, we record depreciation expense as a debit. Expenses increase with a debit. And then accumulated depreciation, which is a contra asset account. It basically subtracts from the asset. So here we have a credit of $8,000. And this is to record the depreciation on a truck. So depreciation expense is recorded on the income statement. Accumulated depreciation is, again, a contra account, and it's reported on the balance sheet. The book value is a depreciable asset's cost minus their accumulated depreciation, and the book value is what is reported on the balance sheet. So here we can see we have the truck, we subtract out the accumulated depreciation, and we have a book value now of $33,000. And so here we see a straight line depreciation schedule for this truck. The final column on the right shows the asset's book value, which is its cost less the accumulated depreciation. So notice that the depreciation expense is the same every year, and the accumulated depreciation is the sum of all depreciation expense recorded to date for that asset. At the end of the useful life, the asset is said to be fully depreciated. And as an asset is used, accumulated depreciation increases and the book value decreases. So we see the accumulated depreciation increasing, the book value decreasing. And the asset's final book value, if you have done everything correctly, will be its residual value. It's kind of nice to be able to, verify that you have done everything correctly. The next method is the units of production method. This method allocates a varying amount of depreciation each year based on the asset's usage. So when a plant asset's usage varies by year, the unit of production method better matches expenses with revenues. And then finally, we have the double declining balance method. This is an accelerated depreciation method that expenses more of an asset's cost near the start of its useful life and less at the end of its useful life. The main accelerated method of depreciation is the double declining balance method. This method is an accelerated depreciation method that computes annual depreciation by multiplying the depreciable asset's decreasing book value by a constant percentage that is 2 times the straight line's depreciation rate. Okay, so this concludes our mini lecture for Module 4. I'll post this in the discussion along with a follow-up question for everyone to answer, and I'll see you in the discussion.